major issues. We'll see. Let's hope so. You never know, but so far I think so good. Trying to see if I'm getting here any issues, but to be honest, I haven't seen it. I haven't seen anything bad yet. As you guys come in, please kindly let me know if everything is going well, if you can hear me well. That would be great, of course. And we can kick it off in a few minutes or a few seconds. So bear with me, guys. I'm just trying to make sure that everything is fine. You never know. But I think so. I think apparently everything is good. Don't forget, guys, as you come in, please drop that like and subscribe. We are extremely close to 750 subs. I think we are at 747. I think it's going to be a good live stream today. Sorry, I haven't produced that many videos, but it's been extremely busy at work. So unfortunately, I haven't had the time to go really into depth into many things, and creating content just for the sake of it without being, doing at least a little bit of research is not really for me. Guys, let me know if you can hear me well. Thank you very much. So let's go on. So big movements on stocks. We've consolidated indeed last week, very around the same for stocks, with exception of the last day, Friday. Friday was a big movement day, but we did see quite the moves in stocks recently. The top performer has actually been the Nasdaq, which makes some sense because it's been lagging completely the other indices. CM Clay is here again. Thank you very much for joining in. Thank you. Yeah, welcome. I hope you enjoy today's stream. So actually last week and on Monday I was talking about a softer than expected CPI, and if that would lead into a pump in crypto and into stocks rallying. The reason why I thought that CPI would come. Oh, thank you very much, German guy. Thank you. What I mentioned was, and by the way, you're gonna love this one, is that we were seeing deflation in China. We were seeing lower inflation than expected in countries such as Germany. Today was the UK, but the overall Eurozone was recording lower than expected inflation. If you actually listened to Powell Q&A, you would see that his comments were more, he was giving the impression that pretty much he was done with rate hikes. Why? Because he already knew the CPI numbers for the following week. So these central bankers across the world talk to each other. They have the data in real time, particularly before they go to these kind of meetings. Do you think they get the data the same day that we do? You must be crazy. No, they already know what's happening. So of course, what did happen? So let's compare with people like, I know that I do this a lot, but it needs to be done for people to understand the level of distraction that is out there. So people like Harry Dent, people like Peter Schiff were predicting a monumental crash in stocks. In fact, Peter Schiff has predicted a major Black Monday on the 27th of October. So 27th of October, Black Monday means a drop in the market of 20%. Ever since Peter Schiff made that prediction, the market has rallied almost 10%. I mean, it's completely out. And he was predicting, commodities to go ballistic. No, they actually didn't. I mean, Ethereum overtook gold once again. I mean, Ethereum, so Peter Schiff in 2011 predicted gold 5,000. Okay? It's 2023, almost 2024, and we haven't even seen a 2,100 gold. So Ethereum came out at 31 cents in 2014. 2014, 31 cents. It went from 31 cents to $4,900 in 2021, meaning it almost hit the $5,000 target of Peter, had a massive bear market into the 800, and it reached 2,100 quicker than gold did. And these people are, again, with the same arguments, the same predictions, wrong and wrong and wrong once more. And people get completely destroyed by these guys. And the thing is, they sound really nice. What they're talking about seems to make sense. And then people typically don't spend the time to actually go and figure out their track record. And people get completely destroyed when they enter the markets by listening to these guys. So what's been happening? What I've been saying. When I started my channel back in June, I said higher for longer. The Fed and the central banks want to keep rates higher for longer. And that's going to be bullish if nothing breaks. That's what I said. At the time that I said this, everybody, from financial analysts, from people on YouTube, crash, September rate cuts, October rate cuts, because we're going to be in recession, blah, blah, blah. I said, no recession. No way. Then a couple of months ago, they started talking about how, for sure, we're not going to have a recession in 2024. So what did I say? Be on the lookout for a recession in 2024. I said softening of CPI, while Peter Schiff was saying explosion of CPI. I said softening, no more rate hikes, and next year, rate cuts. Now, I was reading CNBC the other day, I think on the 13 or 14, all big banks predict rate cuts. The same banks that were predicting rate cuts this year, the same banks that a couple of months ago were saying higher for longer, and now are predicting rate cuts again. They are always behind the curve because they do not look at the data. Number one, from an overall perspective. Do you think if the Eurozone is posting lower inflation, if China is posting deflation, do you think the US will somehow produce huge amounts of inflation? No. But here is the key, and I've said this before. It doesn't matter the reality of that inflation. It matters what the market thinks of it. The market wants to see low inflation numbers. Now, if you actually go through the report, you'll see that housing, transport, healthcare, insurance, those groceries, those things that people cannot live without are all more expensive. But the rest of the curve is all cheaper. But you see, what people want to see is core CPI drops more than expected. CPI is now 3.1 instead of 3.2 or whatever. This is what they want to see. They want to see confirmation that the Fed will stop here. And hopefully, if the Fed could do it, they would like to stop here, keep selling bonds from their balance sheet. In order for the next recession, they have the ability to lower rates and increase their balance sheet once again. This is what they want to do. You see, the problem, what throws away this scenario, in my opinion, is that in order for you to do this successfully, which would be beneficial for the entire world, you need the Treasury and Congress to stop spending money and collect more tax to repay the debt. That way, you can handle higher rates if your debt is going lower. But if your debt keeps on ballooning and rates are higher, yes, there's going to be a point where you can no longer service that debt, and you will need to basically lower rates once again, which is where I believe we're going to end up in. As you may recall, I've been making this prediction for a long time. I said for a long time, for the long-term followers of the channel, at a time where it was not easy at all to predict, but I did predict all-time highs for the S&P 500, Nasdaq 100, Dow Jones by the latest Q1 2024. Now, this was a time where nobody thought that. This was the time of crash, recession at the end of the quarter, money printing, let's pray that inflation collapses so we can print money again, all of these things. And so all of these people made these predictions and I made this one. And here is the kicker. If I'm right, all these people that made the other predictions, they all charge you money or they all make money indirectly from you. That's the key. I give it for free. No big deal. Because I'm here, again, to kind of share my knowledge of these matters and try to bring some sense in this craziness. You see, we live in a world which is extremely content driven. From YouTube, from the news network, it doesn't really matter. So you need to create topics of conversation. You see, when you tune out the noise and you look at 3 or 4 things, things become clear. But that doesn't sell. Because then you talk about those 3 or 4 things and that's it. And they cannot sell you stuff. They cannot go and try to convince you that if you buy whatever they're selling to you, you're gonna do better. So that doesn't cut it for them. So the idea is to complicate and try to create correlations for the most random of things and try to come up with the stupidest of ideas. Like I saw yesterday Peter Schiff's podcast. Everything went up, but not Bitcoin, and now it's 5% up today. Why? Because crypto right now it's in its own cycle. High inflation, low inflation, we are in a different cycle. Oh, and by the way, it crashed to 35,000. Think about it. Crashed to 35,000. Oh, boy. I mean, it's just... And you see these people, like a lot of the newer people, they get completely mesmerized by all this kind of stuff. And unfortunately, they make decisions that completely destroy their financial futures. And the point is the people creating this kind of stuff, they don't care. That's not the goal here. You guys are completely irrelevant to them. The point that they're making is simply, how can I make the most money from my audience and keep them interested the longest possible? And I will create any kind of stupid connections and conspiracy theories or whatever to keep the audience, instead of actually helping the audience to get a better knowledge of how these things work. No, the idea is to confuse it the most possible, so you find them as your guide. Sorry, German guy said, the US will not pay back their debt, so they can make debt as much as they want. No, but that's my point. What I'm saying is, this is what the Fed would like to do. The Fed would like to keep rates here, but keep selling their bonds from their balance sheet. Why? So when a recession comes, they can cut rates and increase their balance sheet once again. But in order to do this successfully, you need the Treasury Department to help you and stop selling bonds and basically start collecting more tax revenue than spending, so they can repay their debt. But because they are not going to do that, it's a matter of time. I expect it by 2024. Why 2024? Because everybody's saying that it's impossible that we're going to have a recession next year. Oh, great. That seems like a perfect time to have it, is when everybody is guaranteeing you that there's no way it's going to happen. And the rates will need to come down because in 3 years' time, half of the national debt will need to be refinanced. And at these rates, there's no way. So I'm gonna make a prediction that is gonna sound crazy, and maybe it won't get there. I think before 2030, by the end of the decade, and you guys know that I don't like predictions by the end of the decade, But I'll throw it out there in any case. Because of the debt evolution and explosion in the US, by 2030, you will see negative interest rates in the US. Think about it. I'm saying this at the time that interest rates are 5.5%. I think before the decade ends, you're going to see negative rates in the US. We'll see. But I do have the feeling that we're going to start seeing it. Now, crypto. Bitcoin pumping once again. Ethereum pumping. A lot of the altcoins are start moving. You have some gaming coins going up 10, 15 fold. So we're starting to see the brewing of the bull market. I always like it to equate it to, I'm a huge fan of Lord of the Rings, in case you guys don't know. So when Saruman is looking into their troops and he says, a new power is rising. So in my opinion, it is exactly what's happening right now. The basics for the bull market are rising. However, and I need to say this again, everybody's already throwing out $1 million Bitcoin. And look, biggest fan of that scenario. And I do know that with the coming of the ETFs on both Bitcoin and Ethereum, a lot of institutional money will come in. And I've seen, the best estimates I've seen is somewhere between $6 to $15 trillion. 6 is the double of the last peak of the bull market. 15 is 5 times the peak of the last bull. And I do hope that happens. But we are following a very close fractal, a very close approximation of the cycle of the Ponzi scheme that came from China, the Plus token. In case I will answer you in a second, German guy. In case that we do repeat that fractal, meaning the Plus token one, I do think we're gonna see a big sell-off, not to 15K, but probably there's a good chance, particularly if the ETF comes at the same time as the halving or very close by. I would say I wouldn't be surprised to see Bitcoin in the drawdown something like 40% from whatever it's going to be in the beginning of 2024. I still think, sorry guys, I'm still recovering. I still think the ETF will be announced late November, probably the last few days of November. And I do expect it to launch somewhere in January to February, which put it quite close to the halving, which I would say probably going to have quite a big sell-off event. I wouldn't be surprised to see Bitcoin drop something like 40% from 30 to 40 from the top, that local top in the beginning of 2024. But we'll see. Maybe I'm completely wrong. There's debt in their own currency. They have one joker. They have no 100-year bond, but could put them out. The thing with the US. Thank you, by the way. The thing in the US is that doesn't work that well, in the sense that, yes, you can drop 100-year bonds, but the point is their debt is growing at such a pace that, and the majority is short term, that even the percentage, 5 or 6% of 40 trillion, which, I mean, by the rate we are going, it's going to happen in like 3 years. It's, if you actually look, so if you think about 5% of 40, that's something like 5 times, so 5 times 4, talking about, I think you're talking about 2 trillion. 2 trillion is almost half of the entire tax revenue. So that's the issue. So that's why I think they will need to cut rates, because they won't stop having more debt. And then the US has trade deficits with everybody, which means it needs to export dollars across the other countries. And if they inflate the currency too much, then the dollars start coming to the country too soon. And then you can actually have some CPI inflation. You see, this is another good example. Everybody thinks higher rates to lower inflation. Consumer price inflation. Stupid. Why? Because higher rates are a cost to a company. So a company needs to finance themselves. If the base rates are higher, so the way that the company issues a bond, for example, you have the base rate, which is the risk-free rate, which is the Fed funds rate, if you will, let's say 5.5%, and then you pay a premium on top, 3%, 2%, whatever. Why? Because the risk of a company is not as good as the risk of the country. Okay? Very simple. So what happens? With that increase in cost of debt, cost of money, cost of financing, they pass that cost to the consumers, to me and you. So CPI goes higher. But when they lower rates, that cost goes down. People say, oh yeah, but if they lower rates, there's too much money in the market, so we're going to have a lot of inflation. No, just see what happened in the US for the last 14 years, in Europe for the last 12 years, the US and Europe for the last 12 years, and Japan for the last 30 years. It's very simple. The top 20% control 50% of the spending and control 90% of assets, real estate, stocks, bonds, commodities, you name it. So those people who are in the top 20%, yes, those people go to the bank, they get their loans, they buy their assets. Sorry. The bottom 80% is already too much indebted. They have too much debt. So, and they basically live paycheck to paycheck. Probably they get fired. Unfortunately, probably they are already stacked up to the max with bills. So the bottom 80% goes to the bank and says, lend me money. No, they don't care. The bank doesn't care if the rate is 5, 2, 1, 10. Doesn't matter. The bank wants, before anything else, wants the money back. Those people is not certain they're going to get their money back. But the top 20%, with a very nice paying job, with assets, with houses, with businesses, sure, those people get the money. So that's why you see since the Fed started printing, the wealth gap goes like this. It's really that simple. You see, when rates are higher, it's actually, in theory, it would be better for the average person, because, oh yeah, but they could open a savings account and make more yield, right? Wrong, because they live paycheck to paycheck. Sorry, guys. I think I'll have to cut it a bit short, because my voice is going out. But in any case, when I look at the cycle on crypto, we are still running very well. You start to see finally some altcoins to participate, not just the main ones, but a bit smaller ones, participate more decisively. No, Bitcoin didn't crash. We are already close to 38,000 once again. Ethereum is well above 2,000, approaching 2,100. There's no crashes going around. By the way, guys, don't forget, drop that like and subscribe. We are very close to the 750 mark, so I really appreciate it. So, my expectation was correct. The softer CPI. Basically, people are now pricing in rate cuts for next year. I've seen all sorts of predictions. Rates to be cut to 4%, to 3%, to 1%. I've seen all sorts of predictions. We'll see how bad the recession is. However, I have zero doubt that the Fed will print money because it's re-election year next year, and the Fed very rarely goes against the powers that are in power, basically. In any case, guys, I'm sorry. Today I will cut it a bit short. My voice is really going off, and my throat is really killing me. In any case, guys, thank you very much. Don't forget, drop that like and subscribe, and I'll catch you tomorrow. And once again, be very careful to the people who listen on YouTube. Maybe just look at what I've been saying for the past 3 or 4 months. Check how many times I'm right, how many times I'm wrong, and compare it to what all the other people tell you, and basically guide you through terrible path. And very importantly, I never charge for anything, and you know very well that I do this. I'm broadcasting my journey into what I hope to be generational wealth, and I'm sharing my knowledge, or what I think is my knowledge. And I do appreciate you guys being here. The community is growing very well, very organically, and I thank you all for being here. So thank you very much, guys, and I'll catch you in the next